Western Digital Corporation sits at a compelling inflection point in 2026. As a leading manufacturer of hard disk drives, HDDs, and storage solutions, it is riding the wave of exponential data growth driven by cloud computing, artificial intelligence, and hyperscale infrastructure. At the same time, the company faces legacy hardware exposure, cycles in demand, and intense competition from solid-state memory players. The key questions for investors: can Western Digital turn structural tailwinds into sustainable earnings growth? And is the current valuation justified? Beginning with recent performance, in its fiscal first quarter of what the company calls its fiscal year 2026, which ended early October, Western Digital reported revenue of approximately $2.82 billion, representing year-over-year growth of about 27%. Adjusted earnings per share came in at around $1.78, well above market expectations of about $1.59. Gross margin expanded to about 43.9%, up significantly from approximately 37.3% a year earlier. These results reflect both improved product mix driven by higher capacity drives and tighter cost control. What's driving the surge? The key driver appears to be HDD demand from AI and cloud infrastructure customers. Western Digital's management noted that the explosion of data created by large language models, generative AI, and massive training pipelines is increasing the need for cost-effective, high-capacity storage that HDDs are uniquely positioned to supply. Furthermore, the company has secured large non-cancelable purchase commitments from its top customers, including a major hyperscaler through at least 2027. That kind of purchase visibility gives investors more comfort about future demand and earnings clarity. On the strategic side, Western Digital is evolving. It has spun off or separated its flash memory business, SanDisk, in recent years to focus resources on HDDs and storage systems. It is prioritizing Ultra SMR, shingled magnetic recording drives, which pack more data per platter, thereby improving cost per terabyte metrics and improving margin potential. The company is also investing in automation, yield improvement, higher capacity HDDs, and enterprise/hyperscale customers away from commoditized consumer segments. From a valuation and scenario perspective, Western Digital is shifting from being a cyclical hardware supplier to being a more structurally advantaged player in the storage value chain. In a bull scenario, strong AI cloud spending continues, capacity remains constrained, HDD mix improves significantly, gross margins exceed 45%, free cash flow ramps, and the dividend share buyback program accelerates. In that case, the stock could see meaningful upside. In a base scenario, demand remains robust, but growth moderates, margins flatten, and the multiple holds steady, yielding moderate returns. In a bear scenario, if AI cloud demand slows, capacity oversupplies and margins compress, the stock could face pressure similar to past cycles. However, important risks remain. First, Western Digital is still exposed to cyclicality. Storage demand is often lumpy and tied to inventory cycles and hyperscaler buildouts. Second, competition from SSDs and emerging storage architectures could reduce HDD relevance over the long term, though currently cost per terabyte still argues for HDDs in many AI data lake use cases. Third, supply chain risks, raw material inflation, and yield performance issues on high-capacity drives could erode margin gains. Fourth, while recent results are strong, much of the upside is already reflected in the stock price, which has climbed strongly in 2025. Thus, investor patience and conviction will be tested. Given the above, my recommendation is that Western Digital is a modest buy for investors who believe in the secular data storage and AI tailwinds, are comfortable with hardware cycle risk, and are willing to hold for at least a few years. The company offers a favorable risk-reward profile in the context of currently strong demand and an improving margin story. But it is not without execution risk or cyclical exposure. Keep a close eye on product mix, margin expansion, free cash flow trends, and customer commitments in hyperscale/cloud.